I wish Jerome Powell would finally just admit it himself too, because even Janet Yellen and Jake Sullivan over at the Treasury have just unwound 40 years of strong dollar talk to just confessing we need a weaker dollar. We need negative real rates to inflate our way out of debt, to deal with this debt problem that we just discussed. And again, so I know not everyone in the audience, is into the wormy, wonky language of Wall Street. Negative real rates just means we need inflation to be higher than the yield on our 10-year or the yield on our bonds. And that really means you're basically getting no return then on your bonds. So you're admitting defeat. What Jerome Powell wants to do is have his cake and eat it too. He knows we need higher inflation to inflate our way out of debt. He knows we need negative real rates. What the BIS and the Fed do, and I'll say it and I'll say it openly, is they'll just lie about inflation. And again, this is not Matt Piepenburg on a soapbox. This is John Williams. This is even Larry Summers, the former Treasury Secretary. We all know that the official CPI number is just dishonest. It's whatever the Fed says it is, so it's never right, but it's always correct. We've been trying to play this game by misreporting inflation. But now, when you've got Yellen, Jake Sullivan or Trump or Harris admitting that we need a weaker dollar, and this is what I've been arguing with Brent Johnson, we can't afford a stronger dollar. The DXY can't go to 150 because it hurts us more than anyone else. But it hurts us also if we have a weaker dollar, because to your point, if we're going to weaken the dollar, it means we're going to have to lower rates at some point. We will. I don't know when. Everyone's talking. I said in January, it'd probably be September. We'll see. Thomas Hernig at the Fed says, a former Fed, said that'll happen when we have a banking crisis. And we can talk about banking risk, but we will have to lower rates for one very simple reason. Not just all the inflation discussions. It's very simple. Our interest expense on our Uncle Sam's IOU, on our bar tab for spending beyond our means, is going to be 1.7 trillion into 2025. We simply do not have that money. That's our biggest budget outlay right now. And we don't get that through tax receipts and GDP. If we go higher for longer to fight inflation, to Powell's point, stay with higher for longer, we can't afford our own interest expense without creating more money out of thin air to pay our interest expense. So his war on inflation through higher for longer, ironically, is inherently inflationary. That's the fiscal dominance argument. And what Harris and Trump and Yellen and Jake Sullivan are saying, and many others are saying, look, we're not going to beat inflation. Powell has a human, all too human ego who doesn't want to be the next Arthur Burns or doesn't want to be the guy who couldn't beat inflation. He wants to get to 2% inflation by killing demand, by crushing the consumer, by basically raising rates so high that our bankruptcies, business bankruptcies, are up to all 13-year highs, 35% higher than last year. Small businesses, the middle class, are getting crushed because he's crushing demand to create deflation, to fight inflation. Well, thank you very much for that solution if you're an average citizen in America, because that's crushing you. Higher costs of debt, a devalued dollar, higher inflation, higher interest rates. That's the perfect storm for people living month to month, week to week. And so that's how the inflation in Wall Street has not affected the middle class or the working poor, and they're getting crushed by a double whammy. So if we can allow inflation to rip, in other words, admit that we've lost the war on inflation, Powell will have to admit that, and he'll start reducing rates. My theory is he won't do that until we have a banking crisis or a market crisis. And he won't do it for political reasons, but I could be wrong on that. But we have to reduce our interest rates simply because the bond market, Main Street, and most importantly, Uncle Sam can't afford Powell's policies. What they've been doing, though, even though at these 5 3/4 rates and staying where they are, our inflation rate, according to Shadow Stats and certainly Larry Summers, is anywhere between 11 and 15%. It's also very important to remember that the CPI scale and all the tricks they use, the CPI scale is a rate of change, not a price level change. So when we were at 9% and 6% and 4%, that's compounding. That means in the last many years, you've been losing compounding purchasing power on your dollar significantly. Some have said 30% in the last 5 years. So if that's true, if you're making 20% even and you're lucky on the S&P or in NVIDIA or something, you're still losing to actual inflation, that invisible tax that nobody at the Bureau of Labor Statistics or Washington, D.C. want to admit. So as Claude Juncker said, the head of the European Commission, well, we don't like the facts, we lie. I know that sounds dramatic. We're lying about inflation. We're misreporting inflation, and we're saying we're fighting inflation. But as Harris and Trump both, if they're confessing we need to cut rates, that means we can't beat inflation. We're going to have to allow inflation. We'll still misreport it, but we're admitting we've lost the war on inflation. And I think Powell's having a hard time admitting that, because the Fed, they're not stupid, but they're always late. They're always behind the curve. I'm not alone in saying that. I'd hate to be in their position. By the way, I'd hate to be either Harris or Trump. and whoever's going to be in the White House in the next year, because someone joked the other day, I think it was a brilliant analogy, I wouldn't want to be the captain of the Titanic after we hit the iceberg, because there's no solution now in the next 4 years, whoever is in there. And I've been very flippant by saying it could be Santa Claus or Papa Smurf or Albert Einstein or, Nobel Prize economist. We can't fix this in 4 years, no matter what, whether we stay higher for longer, whether we raise rates or lower rates. We can have a very disinflationary recession or a very deflationary market correction, mean reversion, but we're going to ultimately have to create so much synthetic liquidity, in other words, mouse click money, to support our bond market and keep rates controlled and keep markets from completely tanking. And unfortunately, it's inflate or die. And we can still have a very disinflationary moment, but the end game will be, I call it, QE to the moon. I don't see any other way around that. Some people have argued, well, the other way around that is some global reset or global war. And again, I guess that's true. Those are possibilities. I don't know how we'll do a global reset when the G7 doesn't get along with the BRICS nations, and the East and the West are now very divided. There are possibilities, but I think we'll save the quote unquote system at the expense of the currency. And of course, that is a direct bridge into conversation on gold that we've been having for years. And so far, without being pompous, we've been right about the dollar, the de-dollarization themes, the devaluation of the dollar, the debasement of the dollar necessary to cover unsustainable debts. And the conversation, of course, then goes to gold, which is now a tier one asset under the BIS right here in Switzerland. It's a tier one asset next to the U.S. Treasury because it holds its value better than a U.S. Treasury. And so even the BIS has admitted this dollar is unsustainable and this debt is unsustainable. And the only way out of it is to debase it, as every country throughout history, every empire, nation, monarchy, democracy, oligarchy has done at every turning point at the end of a cycle of an empire or nation. They debase their currency to inflate their way out of debt. And that's always at the expense of the guy in the street, of course. It's absolutely theft. It's an invisible tax. But think about it, that's the invisible tax. The inflation, which is also misreported, which to me it's devious to misreport, to be dishonest, to not be transparent, to play around with core CPI, CPI, PCI, CPI, all these different names, but they're just not being honest about what the actual real inflation is. When you take on that invisible tax of misreported, underreported by 50% or more inflation, which is killing every dollar you save, and then you add your actual income tax onto that, that's real tax. And then you add on the additional hurdle of higher expenses. The average American's credit card interest rate is 22 or 23%. That's not devious, that's immoral. So the cost of debt is higher, the value of your currency is weaker, the inflation is taking more from you, and then there's your actual tax bill. All of that together means you are barely able to move as your legs are moving forward. You're not going anywhere, as I say, running uphill in roller skates. Again, this is not sensational. Now, if you're in the top 1% or the top just 10%, that's annoying. If you're in that completely ignored middle class, which was decimated by the Fed, in my opinion, and they had the audacity to say that monetary policy at the Fed doesn't affect social classes, that's simply empirically untrue. It's the biggest wealth inequality in our history. That never ends well for any nation. But, of course, that's affecting the middle class, which is becoming more and more extinct every day. And of course, that also ties directly into social unrest and all the problems in this irreconcilable America, the divided states of America we can talk about. All of these things are tied together. But for the very, very wealthy, inflation, taxation, higher interest or higher debt costs or higher costs of borrowing, that certainly hurts. But for the middle class or the working poor, that's devastating. That means they're out of the game. They're out of the game. Alistair is very, very wise intermechanizations of the U.S. or global banking system. And I think there are a lot of parallels you can draw to that. The roaring 20s in the current era, especially when you see a market driven like an S&P, which is a tech ETF where 20% of its market cap is in 3 names, or a NASDAQ where 30% or 50% of its market cap is in 10 names. That's very familiar to this bacchanalia period of the roaring 20s where the markets peaked before they tanked. And then even after they tanked, they rebounded, and then they slowly really went overboard. You can see the similar parallels in the NASDAQ during the dot-com bubble. You could certainly see those parallels in 89 in Tokyo before the Nikkei crash. So there's a lot of parallels to my prior point. Theoretically, under modern monetary theory, you could say even if markets tanked to a mean reversion of 80%, the Fed could just monetize and nationalize the markets by printing enough trillions to pop it back up. But again, that's at the expense of the purchasing power of your dollar. I think the conversation on banking risk, in 23 wasn't that long ago. We had three of the four largest bank failures in America. We had Signature, SVB, First Republic, and then Credit Suisse, of course, imploded. That had to effectively be nationalized. 2024 with commercial real estate, I think it was Union, New York Community Bank. Their non-performing loans were higher than their loss reserves. These were risks that, again, don't really make the headlines. That's the lie of omission under the current kind of media and political environment we live in. You don't know where to get your data. It's this be calm, carry on. So this banking risk, you could argue, is the pessimism of a sound money advocate out of Switzerland who has a very strong bias towards gold. But you can talk to even the old Fed. Again, I mentioned Thomas Hernig. I really admire him because he's one of the few FOMC officials who has integrity. And when he became president of the Kansas City Fed, his mentor said, Tom, when you come in here, make decisions for the long term and let the short term take care of itself. And what he has said is that his Fed, the one he vetoed every chance he could get from Bernanke on, has done just the opposite. They were thinking only short term, the next generation be damned, in a sense, which was really selfish and political. But what's more important, more interesting about Hernig is before he was the president of the FOMC of the Kansas City Fed, he was a banking expert in the FDIC and he was a banking regulator. He understood banking risk. And he said right now, if you were looking at the U.S. banking system, I just mentioned the European banking system is highly vulnerable to the dollar carry trade and a rising dollar. But what he said is, American banks, we are just one banking crisis away from full-on QE to the moon, because the way he looks at banks, you've got the too big to fail banks have over $600 billion in unrealized losses in their treasury holdings alone, just that. And then trillions more in other investments that are lost under the higher for longer policy, because the higher for longer policy has crushed a lot of commercial real estate loans. So we're looking at trillions of potential losses on our too big to fail banks that took us through this movie before in 2008, and yet they've gotten away with it for another generation, it almost seems. But he says, and he's a former Fed president, and he is a former banking expert, so it's not a gold bug cynical guy out of Zurich saying this. He said it's nonsense how American banks are having this conversation about risk-weighted return. They've got 14% of risk-weighted capital on their books to protect them. He says the real ratio is capital to total assets, and that's about 7%. And in the banking world, that is extremely thin margin of error. So if we have any kind of real hiccup in the economy or in the markets, or even with rates, these banks are skating on, they're driving a bulldozer on very thin ice. And we know what will happen. A BTFP-like solution will happen because no politician, central banker, or commercial banker who's paid on share prices can allow a too big to fail system to collapse. They are too big to fail, but they're too stupid to succeed, because the only way to fix this problem is to create enough of that oil for the engine again. But that oil is getting thinner and thinner and whiter and whiter and wetter and wetter, and it has less and less purchasing power. And that will certainly affect the middle class the most, because they're going to get stolen from again and again. And again, whether you can afford a half an ounce, a gram, or whatever of gold, some people will go way out on that risk branch for Bitcoin, thinking that's an alternative. And we don't have time. We should at some point have a discussion on it. I think that's really risky. It's not a store of value. I'll remind that the BIS has not made Bitcoin a tier one asset. I'll remind that the oil trade is not going to be in Bitcoin. It's moving towards the dollar. I'll remind that central banks are not repatriating Bitcoin. They're repatriating gold, 30 nations in the last year and a half, which Andy Schekman's done a great job of explaining. I'll remind that China and Russia are net settling in gold and not Bitcoin, and that's scalable throughout the BRICS. So again, it's not to make fun of the Bitcoin speculation. When you're out in the rain, you'll try to get in any car to get out of the stress. And I think Bitcoin is very seductive. But let's be honest, I hate to say it, but the central bankers, as much as I don't like them, they're not stupid. And there's a reason that the central banks since 2014 are net stacking gold and net dumping US dollars and treasuries. And there's a reason the BIS has just declared gold a tier one asset last year. And there's a reason why China and Russia are net settling their oil trade in gold. There's a reason why Saudi Arabia and the UAE just joined the BRICS and are starting to make more and more deals in the oil trade outside of the US dollar. I'm not making this up. This is real. It's not the end of the petrodollar. It's not the end of the US dollar, but the dollar is going to be repriced because of what the BRICS are doing. It's going to be repriced because of what our banks are going to be doing. It's going to be repriced because of what our economy is. I mean, it's the economy, stupid, as they say. But this is a debt-driven economic model now. The airbrush version of America after the war, where we were the world's greatest manufacturer and creditor. Now we're the world's greatest outsourcer and debtor. I'm sorry, we're just not that country that we were in the Eisenhower era. And I'm not trying to romanticize, but it was a better America. And now we've got irreconcilable differences in this country. We've got distrust. It's immense in America. And whoever wins in 2024 in November, half the country's going to be furious. There's no bridging. There's just distrust. And there is massive wealth inequality, which means resentment. Resentment is never a good thing for the future safety of our country. And you've got guys like Ray Dalio calling it 50% civil war risk. Elon Musk says it's inevitable. I'm not trying to go there and go that dark. But these guys aren't, in their mother's basements doing Google searches. They're not crazy. That's pretty sensational for me. I hope that's wrong. But we all, when I walk through the streets of America, we see how different Venice Beach is, or South Chicago, or Philly, or Minneapolis. We see it, and we see in the suburbs, we see what meth has done, or fentanyl. So it's a different, sad, tragic world. And all of this, though, is tied to debt. All this is tied to currencies and central banks. It's hard to believe. It's certainly political. But it's a sin to live beyond your means at such a level and then blame it on something else other than your own policies, and then make the middle class suffer theft, and then call that, through misreported inflation, the fault of COVID or Putin or global warming, when it's just politicians buying time through easy money and taking our debt. Again, remember what I said earlier, in 1971, before we decoupled from that golden chaperone, we had $246 billion in government debt. But now that we can print as much money as we want, we have $35 trillion 50 years later. From less than $1 trillion to $35 trillion in my lifetime. That is an important thing to reflect on. What would that do to a family, a business, a government, or an individual who had that much more debt than income? You could live off Visa, MasterCard, and Amex flipping around, but eventually you're going to pay the piper. Or you could steal from somebody else and blame your problems on bad parenting or unfair world. But the reality is, it's because you're living beyond your means. And as a government, our public officials who are supposed to be serving the public are self-serving themselves, getting reelected, even Nobel Prizes in Bernanke's case, by solving a debt crisis with more debt. But the real problem, sadly, despite all the other things, is at ground like it's economic. Grundsätzlich, as we say in Switzerland, it's fundamentally an economic problem. And history moves on philosophy, it moves on human nature, but primarily it moves on when you haven't had a meal in 3 days, or you can't afford your kids' tuition and you're stressed out. It breaks up families, it breaks up societies, it breaks up governments.